let's find out more now. Let's drill down on the top central banks in the world. They're meeting, but we'll focus on the U.S. Fed as they determine the cost of credit. I also know the Bank of England are meeting this week, but let's talk more now with Charlie Robertson. He's the time-traveling economist. And he joins me from the UK. Great to have you, Charlie.
Lovely to be here. Thanks very much for having me on.
Fantastic. It's been a while. But yeah, all eyes on the Fed chair, Jerome Powell, this week. And it seems he's in a tight corner. If he cuts rates, it will seem like the White House has influence over his decision. And if he holds, that's more pressure, from the White House. How are you seeing this?
The markets are really pretty clear in their pricing, which is like very low chance, less than 10% when I was checking on Friday. Less 10% chance of them cutting this week. But the cut for next month, that's fully priced. I'm pretty well fully priced in. And the market's actually looking for 4 cuts, I think by the end of the year. I mean, it really is quite aggressive. And I think the reason, or one of the biggest supports for that, is actually the OPEC Plus decision that you've been talking about this morning. So this drop in the oil price has been Trump's effort to push down the cost, to push down prices, cut inflation. It lets the central bank cut rates, that boosts growth. And the goal here for Trump is, I want to win the midterms at the end of 2026. And he probably has a fantasy that'll help him win somehow a third term, change the constitution. All sorts might be possible if he wins the midterms, and lower oil is part of that. And that is going to make it a bit easier for the Fed to cut next month.
Right, but we're seeing prices, that's oil prices sub 60, at this point. That's good, when you're talking about, fuel prices in, some countries. But when it comes to government revenue, take for instance Nigeria, that's not a good one. So is it for certain, do you see oil prices staying, low, going forward?
Yeah, my view since January, I was talking to Washington insiders then who were saying this is the biggest thing. This is more important than tariffs to Trump. This is more important than the anti-woke agenda to Trump, was getting lower oil down. So my view since then has been we would get oil in the 60s, averaging in the 60s this year and next, I think. And that is very helpful for the states, as I've said. I mean, it's very helpful for countries like East Africa, Kenya, Tanzania, Rwanda. There's a lot of countries which do well out of that. Most countries in Africa actually do well, particularly because other commodities are not crashing in the same way. This is very much Saudi doing what the US wants, and for their own reasons. But other commodities like copper are not suffering that way. So there's countries like Congo are still looking pretty good from the commodity perspective. But for Nigeria or Angola, both facing elections in 2027, both now facing a story of lower than expected oil prices, probably for all of this year and next, there isn't going to be some big revenue boost for the governments to help them win the 2027 elections. So it pressures their currencies. In Angola's case, it makes it more likely they go to the IMF. I mean, that's what most countries do. You get the cheapest possible borrowing you can, and that's the IMF. So Angola, is already talking about those options. For Nigeria, it puts pressure on the Naira. It makes it harder for the Naira to stay as strong as it is at the moment. I know it doesn't feel strong if you're in Nigeria, but 1,600 becomes less likely. 2,000 to the dollar becomes more likely with oil where we are.
Yeah, definitely. Some of us don't see 1,600 as, strong. We're all, or our minds are stuck at, around 800, about 700. So this price definitely not looking strong, for some people. But, talking about countries now that depend on, oil revenue, what do you think, such countries should be doing right now, seeing the direction of oil prices? You've mentioned, heading to the IMF for borrowing. What else is there?
There is the IMF, and then there's the weaker currency. Now, this was used very well by Angola in recent years. They let the currency strengthen when oil prices were going up because they got so much more oil revenues in dollars, they could afford to let the currency strengthen, and they let the currency weaken when oil prices went down. So they got a lot more Kwanzaa revenues, even though, or they, at least they didn't have a big drop in Kwanzaa revenues when the oil price dropped in dollars. And that hasn't worked in Nigeria because of the fuel subsidy. So the fuel subsidy wasn't so good for Nigeria when the oil price went up because so much of the money got lost. Admittedly, there was a fiscal saving when it went down. But now the fuel subsidy is gone, it's more straightforward that if the government wants to keep revenue in Naira coming in at a roughly stable rate, let the currency adjust by as much as the oil price has fallen. So if the oil price is down 20%, let the currency drop 20%. And then in Naira terms, revenues are just the same for the government as they were before. So that makes the fiscal a bit easier. But it adds back to that inflation issue. It means the central bank has to keep rates a bit higher than they would have done otherwise. And that then is keeping the domestic debt interest burden quite high in Nigeria, too high. And there's no easy solution when roughly half of your revenues come from oil and the oil price goes down. There's no easy way out. Or in the long run, you diversify your economy. And in the long run, Nigeria is going to do that because oil is such a small, there's so few oil revenues per person in Nigeria. It's a couple of dollars a week per person. It's nothing. So in the long run, Nigeria will diversify, but in 25, 26, it's looking tough.
All right, so definitely, I guess the right time to diversify was sometime yesterday for sure, but hopefully we get that, going forward. But I know you like to time travel. What are you seeing for the global economy, going forward for the rest of 2025? We know the tariff jitters, they're still there.
It's pretty atrocious what we've seen just on US growth alone. The forecasts, 8 weeks ago, at the beginning of March, 2 months ago, we were at 2.3% for US growth. That's what people thought. 2.3% for the US. Everybody else in developed, Europe, UK, Japan, they're all going to be like 1%. Now they're still at 1%, but America's been slashed down to 1.4%. This is the consensus view. Basically, America's looking as weak as everybody else. Even China, cut by the IMF from 4.5 to 4. So it's looking pretty feeble this year, and it's looking pretty bad next year too. I mean, this is kind of 1.5% growth rates for next year for the US instead of 2. This is not great, which again is why Trump is putting pressure on the Saudis. Please, 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 up output. Because if I can boost my economy in any way through lower oil, making the American consumer happy, lower oil allowing the Fed to cut, maybe I get the better growth by the second half of 26 that I want for the midterms. So it's not looking great. Growth needs to be homegrown, particularly in Africa now, because you can't rely on the world economy. And that's going to be relatively easy for some of the East African countries, a few of the North African countries. Morocco's stock market's boomed this year. It's one of the best performing in frontier markets globally. In fact, it is the best. I think it's up 30% in dollars this year. Why? Because they import oil, their interest rates are low, and they're not badly affected by the tariffs. So no, it's not going to be, it's another 2 years where we're going another period of problems. Used to be COVID, then it was Russian oil shock because of Putin's invasion, and now we get this with the tariffs being added in, which doesn't help at all.
Right, and definitely we're seeing the outlook there for most of the economy is not looking too strong. And I'm wondering, what should the smart investor, be doing right now, seeing all of this happening? We're seeing the Oracle of Omaha there. They're in a lot of cash, at this point. What do you think the investor should be doing?
Well, I think we've been in a 50-year cycle of the world investor loving or hating developed markets and emerging markets. And if you love developed, if you love America, then you're hating on emerging and Africa as well. And we were last here back in about 2000, 2001. US tech was amazing. Google, Microsoft were going to be the next big things, Amazon as well, Apple, it was all great. Then we had the tech bubble. Then a few years later, we had the global financial crisis. And by the end of that 10-year period, we hated developed markets. And we all thought the future was emerging. China was was the new story, the new best way of running a world away. Now we've gone back to 2000. Don't like Chinese property anymore. We love American tech. So what I'm expecting to see is disappointment with US at first. And that's going to see them underperform. It's been happening already this year. And you're going to start in about 2 years' time for people to start saying, hey, there's something good going on and emerging. It's not as bad in Africa as we thought it was, as we priced it for. Because right now, assets across the continent are so cheap. So what I think, if you've got a long-term hat on, then African assets are actually some of the cheapest and best value you can buy in the world. Not every oil exporter today, that's true. But there's lots of opportunities across the continent.
All right. Thank you so much. Always great having your perspective. That was Charlie Robertson there, the time-traveling economist. Thank you for joining us today.